You see a fishing boat pull into the harbor, low in the water, decks stacked with totes, and the math looks simple. That catch is worth something. The boat caught it. Subtract fuel, subtract crew, keep the rest. It's the oldest business model there is. Go out, take something valuable from the wild, bring it back, sell it. That model is basically accurate for maybe half of what actually determines whether that boat owner ends the year ahead or underwater. The other half is invisible from the dock, and it has almost nothing to do with fish. Here's the part most people never learn. In a huge number of commercial fisheries, you cannot legally catch and sell fish just because you own a boat. You need a second, completely separate thing, a permit, a license, or a quota share. And in many fisheries, that second thing costs more than the boat itself. It's issued by a government agency, but once issued, it trades on a private market like a stock, going up and down in price based on how good or bad people expect future fishing seasons to be. You don't own a fishing business when you buy a boat. You own half of one. The other half is a financial instrument you have to buy separately, that a bank probably won't lend you money against, and whose value can evaporate in a single bad season, taking a big chunk of your net worth with it. That's the part of the industry nobody puts in the recruiting brochure, and it's the part that actually decides who survives. Let's start with the version most people imagine, because it's not wrong, it's just incomplete. You buy a used commercial fishing vessel. Depending on the fishery, that could be anywhere from a few $100,000 for a smaller trawler or gill netter up toward $1 million or more for a larger crab or longline boat with modern refrigeration and electronics. You hire a crew, usually paid a percentage of the catch rather than a flat wage, which sounds risky for them but actually shifts a lot of risk off the owner in bad years. You go fishing during the season. You sell your catch to a processor or a dock buyer. Straightforward. Except before any of that, in most valuable American fisheries, Alaska salmon, halibut, sablefish, most crab fisheries, plenty of others around the world, you need that separate piece of paper. In Alaska, it's usually called a limited entry permit, or in more modern systems, an individual quota share that entitles you to catch a specific amount of a specific species in a specific area. These systems exist because unrestricted fishing crashed stocks decades ago, so regulators capped the number of people allowed to fish commercially and required a permit to participate. Once that cap was set, the permits themselves became tradable property, bought and sold between fishermen, completely apart from any boat. And that permit market moves on its own logic. In the Bristol Bay sockeye salmon fishery, a drift net permit has recently cost, on average, around $185,000, on top of a fishing boat running roughly another $250,000, meaning the entry ticket alone, before you've caught a single fish, can run close to $500,000. And that permit price isn't fixed by any regulator. It moves week to week based on what buyers think future seasons will be worth, the same way a stock price moves on expected future earnings. Except there's no prospectus, no audited financials, just brokers and rumor and last season's dock price. This is where the first assumption breaks. You'd think the safest financial move is to buy the permit with a bank loan, the same way you'd finance a house or a commercial truck. Most banks won't do it. A limited entry permit can be suspended or forfeited for regulatory violations. Its value swings wildly with the market, and it isn't the kind of collateral a conventional lender wants to hold if a borrower defaults. Private banks and many other lending institutions don't honor these limited entry permits as collateral in securing loans, which sounds like a small technical detail. It isn't. It's the detail that quietly restructures the entire financial relationship between a fisherman and the industry.
If the bank won't lend against your biggest asset, where does the money come from? A significant amount of it comes from the very processors who buy the fish, the seafood companies on the other end of the transaction. They advance fishermen money for permits, boats, fuel, gear, and operating costs, and get repaid with interest out of future catches sold back to them. Which means the company setting the price you get paid for your fish is frequently also the company you owe money to. That's not a conflict of interest in a legal sense. It's a completely normal, decades-old arrangement in this industry. But it does mean that two sides of your business, the price you're paid and the debt you owe, are often controlled by the same counterparty. You are not just selling fish to them. You are financially entangled with them before you've caught a single one. So now you're not managing one business. You're managing three separate, semi-independent markets that all happen to live on the same boat. Market 1 is the fish itself, how many pounds you can physically catch, which depends on the run size, the weather, your gear, your timing, and honestly, a fair amount of luck. Market 2 is the permit, an asset whose price is set by other people's expectations about Market 1 that can rise or fall by tens of thousands of dollars in a single off-season with zero action on your part. Market 3 is the dock price, what processors are willing to pay per pound this year, which depends on the global protein supply, exchange rates, competing farmed fish, and demand in export markets thousands of miles from your harbor. You control almost none of the three. You're leveraged into all of them simultaneously the moment you buy in. And that's before you get to the boat itself, which behaves less like an asset and more like a hole you pour money into that occasionally produces income. Fuel is typically one of the largest single operating costs, and it's a cost you can't defer. You burn it whether the season is good or bad. Insurance on a working vessel is expensive, partly because commercial fishing remains one of the more dangerous jobs by injury and fatality rate, which insurers price accordingly. Maintenance on a hull and engine that spend months in saltwater is constant and unglamorous. Hydraulics, refrigeration systems, electronics, all wearing down simultaneously. And the boat itself depreciates the entire time, the same as any piece of heavy machinery, while a permit can theoretically hold or gain value. You can have a genuinely excellent fishing season, big catch, good weather, no breakdowns, and still come out behind, because the season only measures Market 1. It says nothing about what happened to Markets 2 and 3 while you were out on the water.
Which gets at the counterintuitive part. A boat coming into harbor stacked with totes looks like success. It might be. Or it might be a fisherman having his best physical season in years, while the price he's paid per pound has been cut in half from the year before, meaning that stacked boat represents less revenue than a half-full boat did 2 seasons earlier. The volume is visible from the dock, the price per pound is not, and the value of the permit sitting in a drawer at home quietly losing 1/3 of its worth over the winter because buyers got spooked by this year's low prices. That's invisible from anywhere. A healthy-looking catch can sit directly on top of a genuinely bad year. Now here's the chain reaction, and this is the part that turns individual bad luck into an industry-wide event.
It starts somewhere that has nothing to do with any single fisherman: global supply. Farmed salmon production worldwide has grown enormously over the past couple of decades, and farmed fish behaves completely differently from wild fish in a market sense. It can be produced on a predictable schedule at a predictable volume, which wild fisheries can never promise. When farmed production surges, or when a wild season happens to be unusually large across multiple regions at once, the world simply has more salmon than it did the year before. More supply, same or slower growing demand, and the price every processor is willing to pay at the dock starts falling. Not because any single fisherman did anything wrong, but because the global market shifted underneath the entire fleet at once. That price drop hits every boat in the fishery simultaneously, and it hits hardest on the fixed costs that don't move with revenue. Fuel doesn't get cheaper because your fish is worth less. Loan payments to the processor don't shrink because the price crashed. If anything, they become harder to service out of a smaller catch check. So fishermen respond the only way they can in the short term. They need more short-term cash to get through the season, which usually means borrowing more from the same processors on interest terms that reflect the fact that this is short-notice, higher-risk lending. Fishermen needing smaller amounts of startup money for fuel, hardware, and other goods can expect to pay interest rates 2 points above prime by the end of their seasons, a real cost layered directly on top of an already bad price here. Meanwhile, permit buyers are watching all of this from a distance and drawing an obvious conclusion. If this year's price was bad and next year's might be too, a permit that entitles you to fish this particular fishery is worth less than it was. So permit prices fall, sometimes sharply, sometimes within a single season. A Bristol Bay drift net permit that sold for over $225,000 in one season had brokers offering the same class of permit for as little as $140,000 just months later, more than a 1/3 drop in value in a matter of months, with no change to the regulations, the fish stock, or anything the permit holder actually did. That's the asset a fisherman was counting on as collateral, as retirement equity, as the thing they could eventually sell to fund an exit, dropping by 6 figures while they were still out on the water trying to make that season's numbers work. And that's the trap closing. The fisherman who needed to borrow more because prices were low now owns a permit worth less than what they borrowed against it.
Selling out doesn't solve the problem, it locks in the loss. The processor is owed money regardless of what the permit is currently worth. The only path that doesn't crystallize a loss is going back out and fishing again next season, hoping prices recover, adding to the debt if they don't. One bad price year rarely stays contained to one bad price year. It becomes a multi-year financial hole that the next several seasons have to dig out of, assuming the market cooperates, which it doesn't always do. This isn't a hypothetical. It's close to exactly what happened in Bristol Bay, Alaska, home to the largest wild sockeye salmon fishery on Earth over the past several years.
For a long stretch, Bristol Bay was the fishery people pointed to as proof commercial fishing could still make you real money. One fisherman testifying before Congress described a single season where his one boat harvested $650,000 worth of salmon, the kind of number that pulls new entrants and outside investment into a fishery, pushing permit prices up further as more people wanted in. In a genuinely good year, a Bristol Bay sockeye fisherman could gross somewhere in the range of $300,000 to $400,000 before expenses. That's the version of the story that gets told at the dock and in the recruiting pitch to the next generation. Then came the price collapse of 2023. The dockside price for Bristol Bay sockeye had been $1.75 per pound in 2021. By 2023, it had fallen to roughly 82 cents per pound, a drop of more than half in 2 years, driven largely by the same fishermen who'd built the industry, pointing to the same cause, a global surplus of wild and farmed salmon flooding a market that hadn't grown to absorb it. Some processors were paying as little as 80 cents a pound that season, half of what they'd paid the year before, and among the lowest prices the fishery had seen since 2015. Where a good year could gross a fisherman $300,000 to $400,000, that low-price year brought the same effort down to roughly $100,000 gross, before subtracting fuel, crew shares, insurance, maintenance, and debt service, all of which stayed exactly where they'd been the year before.
The permit market reacted almost immediately. Permits that had traded for over $225,000 the previous fall were being offered for as little as $140,000 within the same year. Real equity, on paper, gone for permit holders who hadn't done anything except own a permit in a fishery that had a bad price season. And underneath all of it sat the debt structure the fishery had leaned on for years. Because banks generally wouldn't accept the permits as loan collateral, a substantial share of the industry's financing ran through the processors themselves, the same companies now offering historically low prices. Government relief loans during the pandemic had also pushed roughly $263 million into Alaska's finfish industries in 2020, propping up boats and permits through a difficult stretch, money that eventually needed repaying, arriving right as prices were about to fall further.
By the following season, the mood on the docks had shifted from confidence to something closer to bracing for impact. Fishermen openly discussing how long they and their neighbors could keep operating at those prices, whether the processors themselves were financially healthy enough to keep extending credit, and whether the whole financing structure of the fishery, built for a market that no longer existed, could hold. Prices partially recovered the next season, and the industry didn't collapse, but permit values didn't simply snap back. Debt taken on during the low years didn't disappear, and a fishery that had spent decades being cited as one of the last profitable frontiers in American fishing spent a couple of seasons looking a lot more fragile than the brochure version suggested. What that episode proves isn't that Bristol Bay is uniquely troubled. It's a well-run, tightly regulated, genuinely productive fishery by most standards. What it proves is how the underlying financial structure common to most limited entry fisheries turns a normal commodity price swing into something closer to a credit event. Take a business with two separate volatile assets. Finance one of them through the same company that sets your revenue, and a bad season doesn't stay a bad season. It becomes a balance sheet problem that outlives the season that caused it. The industry has adapted to this reality, mostly by consolidating around it, rather than dismantling it. Permit and quota leasing has become common. Instead of a young fisherman buying a permit outright for a six-figure sum, they lease fishing rights for a season from someone who already holds one, usually an older fisherman easing toward retirement or an investor holding permits as a pure financial asset. That lowers the entry cost, but it also means a growing share of the value generated by actually fishing flows to whoever owns the permit rather than whoever does the work of catching the fish, which is its own quiet shift in who a fishery's profits ultimately belong to. larger operators have bought up permits across multiple fisheries and seasons to diversify against exactly this kind of single fishery price crash. The same logic an investor uses to avoid putting everything into one stock. And in several fisheries, family-run operations that once passed a boat and permit down through generations have increasingly sold out to larger, better-capitalized companies that can absorb a bad price year without a debt crisis. A slow consolidation of an industry that started out as one of the most independent, small operator businesses in America.
So, what does owning a fish boat actually look like, honestly, across the range of outcomes? Best case, you enter a healthy fishery with rising demand, hold a permit that appreciates, run efficient equipment, and a run of strong seasons lets you pay off the boat and permit within several years, banking real income on top. Some fishermen genuinely live this version, and it's a legitimate, well-paying, independent way to make a living. Realistic successful case, you break even most years, profit meaningfully in the good ones, and the permit functions as a forced savings retirement asset you eventually sell, assuming you time that sale for a strong market year rather than a weak one, which isn't always in your control. Realistic negative case, an average season on the water next to a below-average price year. Debt service to a processor eats most of the margin, and you spend several seasons treading water rather than building equity, waiting for a price recovery you can't schedule.
Failure case. A low price year lands on top of existing debt. The permit that was supposed to be your exit strategy loses a third of its value overnight, and selling out locks in a loss instead of funding retirement, while the debt itself doesn't go away just because the collateral did. All four of those outcomes can happen to the same skilled fisherman doing the same competent work on the same boat in consecutive years. Skill at catching fish barely moves the needle between them. So the boat was never really the business, it's the tool. The actual business is holding a leveraged position in 3 markets simultaneously. The volume of a wild resource you don't control, the price of a commodity set by global supply thousands of miles from your dock, and the value of a government-issued right to participate at all, priced by other people's expectations and financed, more often than not, by the same company that decides what your catch is worth. The ocean is the only part of that arrangement that was ever actually free. Everything else on top of it, the boat, the permit, the debt, is a financial structure that happens to require going fishing to service it.